dentist, doctor, or small business owner, you're probably feeling the weight of balancing your demanding practice with your personal life, right? It's tough to find the time for family, to focus on your health, or even think about your financial future when you're always grinding away at work. To the Dr. Josh Cochran Show, where I'll focus on empowering professionals like you to build passive income and achieve financial independence through real estate and smart investment strategies. Each episode, you'll discover practical steps and real-world stories to help you create long-term wealth and gain more time to focus on what really matters: health, family, and freedom. You're ready to break the cycle and start living on your own terms. This show is for you.
All right, good morning, everybody. So we'll talk about opportunity zones today. Eric has been kind enough. Eric Appelsies, Dr. Eric Appelsies is a good friend, has been kind enough to moderate. Eric always asks good questions and always helps me simplify things. I tend to get complex and into the details, so I appreciate Eric being here today.
Yeah, of course.
Eric, did you want to say anything before we get started?
No, I mean, I don't know, but my goal is to just try to maybe ask the questions that other people would have who are maybe more novice in this space with opportunity zones. Because for me personally, I've never invested in any of them. And so I had a chance to look over the PowerPoint and have Josh explain it. So hopefully I do a decent job of maybe getting some of those answered for us.
I appreciate it. You'll do great. Okay, so this is a big event for most of us. This may be the largest capital event of many of our lives. So it's really important to know the different options out there. And I do a lot of research. I have a finance background. And this is the best solution I found. So I wanted to share that with you, and you will be aware, you will understand it. I have a fund myself, so this is not benevolent. I have friends from our GPS deal who are investing with me on this, and hope you would too. But if not, no problem too. Happy to support anything I can do to educate or help. This is a big thing for all of us. A little background on myself. So I founded a practice in 2014 in Spokane, Washington. First year from scratch was the worst thing that ever happened to me. It was brutal. I learned a lot, wanted to sell. No one would buy my problems, but it was the best thing that happened to me too. Doubled down, started adding team members, other doctors, and really found some wonderful doctors and wonderful team members. And we grew that group to 160 team members. Big thing for me is life and family. I have 3 little kids and a wife, and I didn't want to miss out on that. And so, GPS is a great partner to take a lot of that burden, and frees me up to be a family guy and also follow my passion, which has been real estate development. So been doing real estate since about 2018. I always loved it, but in college I had no idea how to do it. And so it just kind of worked out that over time I fell back into it. So half of what I do is real estate development and construction. The other half of what I do is I run a couple funds, including this one, to help people grow their wealth and mitigate taxation. All right. So starting up today, we're talking about the Inland Northwest Qualified Opportunity Zone. This is a structure to defer and eliminate capital gains tax with real estate development. This is my lovely family. This is my why. I'm the biggest investor in all of this. So this is the solutions I use. So you're investing alongside me. We'll go over the QOZ. So disclaimers, this is not financial, legal, accounting advice. These are just my opinions. Hopefully. So today we're going to talk about qualified opportunity zones. What are they? The 2025 updates. They are in the new tax bill. A fund overview, why real estate, just fundamentally as an asset class, and then about Cochran Capital and my development company as well, real estate. Qualified opportunity zones. So they were started in 2017 with the Tax and Jobs Act. So basically, how do you take the maybe not the nicest areas in town that you want to gentrify. You want to bring them up, right? Well, you create tax incentives. So this is a federal tax incentive that was created to uplift these neighborhoods, to incentivize developers. And it's worked. If you look at like some of the federal numbers, since 2019, we have over 100 billion invested in opportunity zones. So this is a program that's just continued to grow. I actually tried to do an opportunity zone for one of my startup dental practices, but the accountants and the attorneys hadn't quite figured it out yet. So we didn't end up doing it. But it's just continued to scale. And with it being in the new tax bill, it'll continue to scale and build up. It's just, well, we'll get to it, but it's really great. This is the issue. Usually if you have a capital gain, you need to take that capital gain and invest it within an OZ fund within 180 days. That's kind of like the rule of thumb. However, if you sold, let's say, a practice to GPS in 2024, if that practice was a S corp or a partnership, you actually have till around September 10th. So 180 days from the tax extension. So this applies not just to 2025 for folks, but also to 2024. Eric, if I'm missing anything, feel free to just.
No, that was really clear. I don't have any questions so far.
Okay. So we'll go into the benefits here. There's a tax deferral piece in the front, and then there's tax elimination. Then there's also tax efficiency and cash flow. So there's three parts that really make this work. And it's not so much about the initial deferral of capital gain tax. Those are pennies compared to the long-term benefit, which we'll go over. Okay, so as the legislation is today, this is what your timeline would look like. You invest cash either 180 days from your sale, or like I said, if it was a partnership or an S corp, into the QOZ fund by September 10th-ish. You're able to defer that initial capital gain tax until 2027, which is April 27, which is actually the 2026 tax year. Okay. Every year I look at where my income's coming from, right? Like capital gains, ordinary income, and then I look for the best solutions that year, and I solve my tax problem for that year. So when you're looking at a QZ fund, there is a deferral, and then in 2026, it's like, okay, what are my solutions this year to handle that capital gain tax? But the biggest benefit by far is all capital gain tax, depreciation recapture tax are eliminated. Okay. And that's massive. It's around a 40% bonus to your returns. Okay.
Hey, Josh,
we'll break that down. Yeah.
I had one quick question. So if, let's say for some scenario, I have $100,000 that in capital gains, right? That after this recap, hopefully it's more, right? But let's just say it's that. But I'm like, oh, well, this fund makes sense. Like it works. Can you also invest just cash, or does it have to be, can you only put capital gains into a QOZ, or does it only make sense to do that?
It's cleaner just to have capital gains, right? So like we'll get more into this, but each project is its own LLC. Okay. So what we could do if you wanted on like a certain project, like the one I'm presenting today, we could have our qualified opportunity zone fund invest as one investor, right? And then people could invest outside of that through like another fund of mine without capital gains. Okay. But you don't get all the benefits, right? So it's really you're just underwriting that investment independently without the capital gain bonus 40%.
Okay.
Comparing it to your other investment options, but definitely.
Josh, I just have a quick question.
Yeah.
So let's say at the next recap, you get a $1 million total payment. Are you required, not required, but is it just, would I just be investing, say my long-term capital gains tax rate is 25%, which is $250K. Am I required just to put the $250K in, or the entire $1 million into the opportunity zone fund?
Yeah. So when you sell something at a sell price, I'm just going to briefly cover what capital gains are, right? You sell something at a sell price with your accountant, you have a basis value for that asset, right? Your dental practice, each year you depreciate assets, so you have a basis value, which is not zero. And so you take the sale price and you subtract the basis value. And whatever that is, that's what you're paying the capital gain tax on, right? So what I would recommend people investing is all or a portion of the sale price minus basis, right? So if your basis on your dental practice is, $1 million and your sale price is 2 million on those shares, right? You have $1 million in capital gain and you have $1 million you're getting that is not taxed at capital gain. So just the top million. Was that clear?
Yeah.
So then, Josh, does basis mean, in simple terms, this is what you're getting taxed on? So if the sale price was $1 million, but your basis is 600,000, you have taxable income on 600,000 of that?
It's the difference. It's the difference between the basis and the sales price.
So it'd be 400,000 in that scenario if you had
100%. Yep. Great question.
And then the percentage of capital gains off that 400 or the entire 400? Do you see what I'm saying? Like, say if there's no depreciation, if I've already taken all my depreciation, if I get $1 million, here's $1 million check. Out of that $1 million, my accountant would say, Rick, you owe your long-term capital gains rate's 25%. So you owe 250K.
It would be on the 7. It would be realistically, if you depreciated your dental practice heavily and you owned it, like, let's say 5 years, I'd have to check. The ballpark, the first number coming to my head is like 300,000 left in basis. So you sell the practice for $1 million, 300's on basis. You do not pay capital gain on that because you do not depreciate that piece yet. So the 700K is what you're paying your capital gain tax on. Now, typically for active capital gain tax, like you owned your practice, right? Typically active capital gain tax is 20%. Passive is 23.8. So
I was adding the 5%. I was adding the 5% for Virginia.
State.
Yeah.
Usually state is not included in these things. We'd have to talk to your accountant to make sure.
Okay.
But what I've seen this in the past, like states are just like not super helpful on that part.
Okay.
And then Josh, so I think what he was getting at too, though, if that was the case, you would need to invest that 700,000, right? Or whatever was still taxed. That's the amount. You wouldn't invest what the capital gains tax would be. So if the capital gains tax was 20% of 500,000, you're not investing.
Gain.
Yeah.
It's the gain.
It's the total amount. Yeah.
I would recommend, yes. So I would recommend it, yes, taking 700K and investing it in my OZ fund or another OZ fund where somebody that you really know, trust, have a good track record, right? That you have a deep relationship with. And then the 300K, invest that however you want.
Let me ask you just one more question. And I know you probably will cover this, but just like any investment, you can make money and you can lose money. If you put money into a fund, and I'm not just saying yours in general, but and it ends up losing, are you still liable to the government to pay that federal tax?
The capital gain tax on your original sale of GPS shares or equity, you're always liable on that one. Okay. The second one, you're not. But we'll talk about risk mitigation and how to not be dumb when you set up funds and set up investments. I'll really go over risk factors. I might put that at the end because I could go over risk factors and how to mitigate them for like an hour. I have it at the end, and maybe that's what I'll do is kind of like, go over that in depth when we get there. Good question. Good. Okay. Is this for me? If you have a capital gain and you believe investing in real estate, like long-term investing, if yes to both, there is no better program than OZ, hands down. Okay. So those are the two things that you have to, so let's talk numbers. So here's a flushed out version of what we were just talking about. In a non-QOZ investment, you put in $1 million, which is the gain, just the gain. Okay. you would get taxed if you're active. I'm assuming active, like this is your dental practice shares. You'd be taxed at 20%. Okay. If this is, let's say somehow we're counting like our sub DSO shares with GPS. Let's say our accountant's saying, no, that's passive, then this would be 238,000. Okay. So your after-tax investment, after you pay that capital gain tax and the non-QOZ, just some other investment, you have 800K left. Okay. I'm assuming now with opportunity zone funds, it's a long-term investment, which I love because long-term, if you set things out right, you win. So long-term, we just assumed on the lower end a 2.5 equity multiple return over that 10 years. Okay. Which would be now things are worth 2 million. Okay. Less a 240,000. I simplified the 23.8 to the capital gain in 10 years. This is how much you would have left, 1.76 million. Okay, this is non-QOZ. In a QOZ investment, and this is why this is so powerful, okay, you're deferring that original capital gain, right? So you're not paying that original capital gain up front. And then you're investing all that money in the fund. And now the year 10 value, 2.5 times a million is 2.5 million. Okay. And currently how the law is written, we'll see if they update it in this new bill, but currently how it's written is the next tax year, this would be due, which means it's due in April, right? But again, every year look for new tax solutions, right? And that's what I do. And so let's say you paid it though, that would be 200K there. So your net to you would be 2.3 million versus 1.6. Make sense? Same exact investment. Let's say you were investing in the same real estate. Okay. Nothing had changed. You're just purely using the OZ structure. And this is why, like, David elected the OZ structure on his first sale, right? Because it's a no-brainer. A 31% increase in your value of your shares doing nothing. You're not investing in two different assets. This would be the same asset, but just using the OZ structure. Any questions?
Josh, if you amortize this over the 10 years, this is like just this example is roughly like a 7% annual return. Is that accurate?
2.5. I try to keep simple math, but I think that's like a 10% return.
Okay.
Yeah. And I'll break down in real estate why I believe real estate average annual returns are 16%.
Okay.
I'll break that down for you later. So I did that on a 10%. Basically, a 10% is like a 2.5 equity multiple, and a 15% is a 4x equity multiple over 10 years on the simplest math. Good. Okay. But that's not all. Wow. So what's nice about OZ funds is they also give you depreciation recapture tax benefit. Okay. So whenever you depreciate an asset, all that depreciation you take allows you to pay less taxes along the way. Okay. And that's what's great. It's one of the great things about real estate. But when you sell real estate or you sell the dental practice, you have to recapture, you have to pay back the government for that depreciation you've taken. Okay. And that depreciation recapture tax is 25%. Okay. So in a non-QOZ investment, we talked about 1.76 being the value, plus you get to depreciate along the way. So we just used some, we assumed an 8-year depreciation at 20 grand a year, 164,000. Okay. So your value without depreciation is 1.9, with depreciation is 1.9 million. But at the end, you got to pay it back. Okay. So you're getting back to this net value. With an OZ investment, you don't have to. Okay. So between it's kind of hard, like you said, like what's my basis, what's my capital gain? But if you're using rule of thumb numbers, between not paying back the capital gain and not paying back the depreciation recapture, That's a 40% increase in your return because you're not paying those two taxes at the end. The easiest equivalent in your brain, and maybe I should have put this on the front slide, it's like having a Roth IRA. When you sell, you do not pay taxes on this after 10 years. What questions do you have? This is like core.
Yeah, Josh, just one point I had. So depreciation recapture, because I didn't know this until right now, because a lot of us are dental practice owners or were fully owners and, had an event with GPS before. So like in my practice, when I say depreciated, I don't know, $200,000 of chairs, equipment, whatever it was throughout the years, right? When I owned it. When I sold to GPS a year and a half ago or whatever, I had to pay taxes on that again. Like, I didn't pay the first time, right? But that when they determine my basis, they're gonna add that amount back in.
The other complicating factor here, which doesn't happen as much in real estate, but happens in dentistry, is whether it's considered an asset or goodwill.
Oh, okay. So you can play more with terminology in a dental practice.
Yeah, that's why GPS is 90% goodwill in their other practices, right? Because they don't want to be like smacking dentists with massive depreciation recapture.
Okay.
Good. Okay.
Yep.
Great question. But in real estate and many other businesses, right, you have way less goodwill, way more like machinery, fixtures, all those kind of things. Good. Okay. I don't think, yeah, we want to keep that at a simple level because that would be a dive in it. Okay, updates on 2025. So Trump administration started the first opportunity zone, and his folks like Scott Turner were instrumental. His current HUD secretary for housing, right, was instrumental in the first opportunity zone. So that like Trump's pro OZ, Scott Turner's pro OZ, Scott Bessent, his head of Treasury Secretary, one of his main core members, is also very strong pro OZ. So they were saying they're going to put OZ in, and they did put OZ in the next tax bill. It still needs to go through like everybody to get all the final comments and additions. But here are the things they've talked about. They want to, and timing is Trump is targeting July to get more clarity, but they'd like to extend deferrals. Okay, we'll see if they do this. They'd like to do some other things like a step up on basis, change the OZ map, which I think they will do. I saw some stuff on that. Ability to invest non-qualifying capital, like you said, Eric, and still get the benefit. I did see something about maybe $10,000. It's not a big deal, but it's kind of like a Roth contribution, right? They are looking at that. Fund of funds. I don't really need to go into that. So they're looking at basic extension, zoning redesignation and expansion, and permanent OZ as well. So it's in the new tax bill, but we can't counter chickens. And
yeah, I have one question on that, Josh. So, and it's in relation to a different asset class, right? Like I had personally invested in the past in like a conservation easement, right? Which was, providing tax benefits. But what ended up happening is it got audited. And it seems like a lot of those got audited, and then we all ended up having to owe taxes. So is there a scenario in this where a new administration comes in, they change the laws, and it almost like you don't get grandfathered into this and you get screwed?
So there are things that are in the gray area, and there are things that are not in the gray area. This one major advantage to this, and I need to say this, is it's not in the gray area. Okay, like the government is like, we love this. They are promoting it. This is part of their platform. So, and everything's like grandfathered in.
Okay, that answers it then.
Okay, you didn't hear like Biden shouting from the rooftops, everybody, conservation easements are the best things ever. You guys should do this, right? But the Trump administration does, right? They're fully behind this. So this is not a gray area tax mitigation strategy. This is an in the light green tax mitigation strategy. Good. Now, if you new guys, let's say another administration ends it, right? You're still grandfathered in. Good. Okay. Okay, fund overview. So I structured this fund like institutional players are there because Institutional players are institutional because they've been there a long time. They've been doing it a long time, right? So they grow to institutional size. So the biggest thing for me on all my investments is a long-term mindset. So I emulated institutional structure on this OZ fund. So our target investment returns are 10 to 15%. Okay. We only pick assets that have fantastic fundamentals. We know real estate does fantastic historically, and we know the projects we're picking have fantastic fundamentals, but we don't have a crystal ball, right? So you always need to be conservative and project conservatively. Okay. So we have a 10 to 15% net IRR. We have a net equity multiple of 2.5 to 4, which ties to that. Our asset types are primarily going to be multifamily, maybe some retail as well. Targeting growth, hold period 10 plus years. 10 years is a requirement of the opportunity zone. It's an opportunity zone requirement. We will sell these buildings because we have enough partners, we will need to sell these buildings at the end of the 10 years. When at the end of the 10 years will depend on the market, right? If the market's terrible at exactly 10 years, we're not going to sell and lose 25%, versus what we could, right? We're going to be patient because we're cash flowing, right? These are not like, if you look at multifamily long-term, like it does well. So we are not going to sell right at 10 years if the market isn't great, but if the market is good, we will exit to give investors back their money. I may create some solutions because this is like a Roth and you technically don't need to end it till 2047 currently. I may create some solutions for people who don't want to exit and they want to keep compounding their equity within that Roth type structure.
So
But we'll
Josh,
get to that later.
this is like a hybrid of a Roth / REIT. Is that fair?
Yeah. So REITs, low returns, diversified across, so many properties, right? And it doesn't have the tax benefits, right? But the structure is similar as like a fund, right? Like you're saying. And then on this one, yes, you get those no taxes on the end. So yeah, I think that's a great analogy.
And what are the assets under, it's a fund, right? So you have assets under management. What are the assets under management right now?
Great question. So literally just launching the fund right now. So what we're going to do, let me get to that because I have slides on that. So it's a great question. Good.
Hey, Josh.
Okay.
Ellie, do you have a second for a question?
Yes, absolutely.
Wonderful. Thank you. This all sounds very good. And we're meeting for the first time, but what is the founder's risk here? What sort of organization do you have behind you? What happens if, God forbid, you're hit by a car tomorrow?
Yeah, absolutely. So redundancy is a fantastic question. So there's redundancy on multiple levels. So there's redundancy on the fund side, like who's administering the fund, right? And I will have another fund manager is like redundancy here. Just like one of my buddies who is he here on this call? Not this morning. Okay. When he's setting up his will and his estate plan, right? If he gets hit, his wife's super sweet, sharp, but she doesn't really understand this stuff like I do, right? So if he dies, like I'm the one helping make sure that his wife is taken care of, right? Understanding all the same thing. So I'll have another fund manager on the fund side. And then on the asset management, same thing. I'll have an asset manager there. And then on the construction side, I already have redundancy in there. So I'll have redundancy at every level to protect everybody.
But today, are you the lone principal in this endeavor?
On the fund, yes, absolutely. Good.
Thank you.
Okay. And I like to keep it that way on the fund side because the larger you get things, the more mouths you have to feed. And then you're having to do deals instead of choosing to do deals. Does that differentiation make sense?
Yeah, I hear it. Just from a diversification, a risk management perspective, I guess I want to know if I was an investor, whether I have outsized key man risk, founder risk. Sounds like the answer might be yes.
Yes. So to keep things simple, yes, this would be greater than let's say I had like 8 people in the organization, right? You're going to have greater risk than that for sure. But I will set up redundancies at every level to take over and share those 100%. It's a great question. So, okay. Okay, so how does an OZ fund actually work? Like step by step, like what is it? So you set up the OZ fund, funds get contributed, like I mentioned, by a certain date required by the government, either 180 days or for an S corp or partnership by like September of the following year. Okay, that's step one. And then on the fund itself, we go out and find great fundamental deals. Okay. And then in an OZ fund, you're trying to uplift these OZ tracks. So you're trying to if you're uplifting, you have to put a lot of capital in. So like minimum, you have to add as much money as you buy a property for. So you can do redevelopment where you buy an older property for, let's say, $1 million. You put in another $1 million. Okay, that qualifies, or all ground up development. So mostly this will be ground up development. I have one redevelopment option that I'm looking at. So those assets may be in there as well. We stabilize the property and then we cash flow it. Usually we refi it and then cash flow to return money to investors. Refi money is tax-free, right? So, once you add a bunch of value to something, Eric and I were talking about this yesterday. Once you add a bunch of value to something, it's worth more than what you put into it, your costs, right? So you can refi and get cash back. And that's really dependent on current interest rates at that time. Okay. And then a sale at 10 years. There are some nuances where I won't get into that. It's too complicated. What questions do you guys have on the first 4 parts?
I guess one, Josh, I would have on stabilizing the property 90 to 95%. I mean, what's the likelihood of getting to that stabilization, or like how do you, is that pretty standard that most places now are at that occupancy rate?
That's math. So national occupancy is 95% now for multifamily, okay, as of this month. Great question. But real estate is local, right? And so our market, the sub-market that this property is in, like my first one, is also at 95%, right? And so what you do is you price your units competitively, right, based off of comparable analysis. And then you get a market report on absorption rate, like how many units fill up per month, okay? So typically on this one, like our first property is like 92 units. Okay. Typically I'm going to fill up, let's say 20 units prior to even having them finished. Okay. Before I get like occupancy from the city. Okay. I'll have 20 filled up prior. And then each month our market is 15% absorption rate. Okay. So 20 units and then you add 15, 15, 15, 15, right? Now you're at 80, 15, you're at 95, right? So this is like, what is that? 4.5 months to get fully stabilized in this market.
Josh,
Good.
These opportunity zones, are these in Spokane around your
Yeah.
area?
So as you guys know in dentistry, if your hands are on it, it's successful, right? If you own a practice across the country, right? Like how much value can you add to that practice?
It's hard.
It's hard. And so I have the same philosophy when I'm doing development. Like I know my neighborhoods very well, right? I know which ones are coming up. I have a very good feel for the market. So when it's close to me, Spokane, Sandpoint, where I'm actually today, Northern Idaho, Tri-Cities, within 2 hours of Spokane, I have a really good feel for the market and I'm going to be able to add the most value. So I really think of this as a dental practice. I think that's the best corollary here. So the closer you to the better. Any other questions on this slide?
Josh, is this your first QOZ fund that you've started?
Yes, I attempted a QOZ for one of my dental practices in 2019, and the legal and accountants just weren't seasoned enough to execute. So just went without it. This is my
But
first
you've
QOZ.
bought other apartment complexes in the past, but not as a QOZ?
So I do development primarily, not acquisition on multifamily, and I will go over those properties for you in a slide soon. Good? Yeah, just not in a
Yep.
QOZ. Yep.
Okay.
I have another fund that's a non-QOZ. It's purely investment fund. We did buy one multifamily last year. Actually, we bought a few multifamily last year. Yep.
So the goal, if we get enough investors, is you will become the Wizard of Oz.
Basically. So it comes down to, we'll go over risks, but sponsor is always number one, right? Like
Sure.
market, asset class, okay. But for me, it's like, who is the dentist running this dental practice, right? I don't care if it's in the best demographics or the worst demographics in the country. Those are important factors, but it's number one is like the who is running that dental office. Because if they've had a good track record, I believe in them, I like them. Like many of the GPS doctors are good friends of mine, right? Like if they were going to start a new group someday, like I know they can do it.
You'd have confidence in them. Yeah.
Yeah, 100%. Okay, so this is the next slide here. Okay, so let's say you build some properties, it's like year 3, year 4, you get them stabilized, you refi them, take some cash out tax-free. Now these are cash flowing and they're depreciating, right? You're getting the depreciation benefits of real estate. Another thing that's in this new tax code is the 100% bonus depreciation. So typically, historically on multifamily and retail, year 1 depreciation for me has been 25 to 35% of the total value, construction cost. So if I build a property for 20 million, I am getting depreciation in the first year of, 25 to 35% of that. Good. So that you get to take that depreciation. That's another benefit. And then after year 10, when the market is good, right? This is not for like Mexican jumping bean investors. This is like long-term sophisticated investors. Okay. When the market is right, we need to sell because we have multiple investors and everybody has a different investing plan. So when we're working together, you have to sell. And then I may create some optionality if it makes sense at that time for people who want to stay in to continue to roll that money within like the raw structure up to 2024-47. I may create that. So any questions there? Good. Okay. And if you guys say your name when you ask questions, for some reason, it's just hard to see on Zoom who's chatting. So the projects we're going to target are going to be close to me, as I mentioned. Okay, let's talk real estate. Some of you know this, some of you don't. What I find is I really need to make sure people understand real estate as an asset class so they understand what they're getting into, the pros, cons. Okay. So like real estate is no longer just like my investment. It's also like, it's what I do. It's what I'm good at. Right. And so, like I'm all in on real estate. Like most of my wealth now is in real estate because it's what I do. Just like when you guys are building up your practices, there's no better ROI than investing in your own continuing education, investing in your own practice. So similar for me. So when I talk about real estate, you got to pick your own portfolio, right? Like stocks are great. Maybe the returns long-term aren't as high, but they have very good liquidity and it's very simple, right? So like, I don't have a problem with equities, but I know that I can compound my wealth much faster with real estate. So that's what I choose to do. So this is a core fundamental slide. This is the most simple model. So, what questions, Eric, do you want to walk through this maybe?
Yeah, do you want to walk through, walk through it together? Yeah, you did a good job explaining it to me pretty clearly. the stock market one seems pretty straightforward, right? Like you're growing at a certain amount and then you're have to take into account inflation. So that's why you're saying your net return is actually only 4 to 6. And I think a lot of us, when we hear, or when I talk to other financial advisors and they'll say like, oh yeah, your stocks grow 8%, they tend not to include that last piece. So it's like, you know, $1 now is worth the same as it is $1 like, you know, 10 years from now. So I think that's one important piece that I need to see, but I don't know if you want to just go through the real estate part like really quick.
Okay. So depreciation of 2.66%, right? That comes off if you're passive, your investment income every year, and if you're active, off your ordinary income. And so that's money you don't have to pay taxes on. Now, I'm trying to summarize depreciation in a simple number, but as we know, if we do cost segs, depreciation is much higher than that in the first few years. So I'm just trying to do the simplest model here of putting a value to depreciation of 2.66%. Okay. Appreciation, you know, depending on what you look at, usually long-term commercial real estate, you know, 2.5 to 3%. If you look long-term, you know, home prices over the last 20 years, maybe this is 4 or 5%, depending on your market. But again, I'm trying to be conservative here. This isn't, I mean, you could put, like I said, 30% first year in depreciation, but we're trying to be conservative, simplify the model. As you know, with your dental loans, every month you paid interest on that dental loan and then you paid off principal. Okay, so this is trying to encapsulate that number over a long period. Cash on cash return, this depends on the project, right? If you just go buy something off of Crexier or Loop.net, you're not going to get an 8% cash on turn. But this is about finding like good, solid deals. You add all that up, 16%. Minus inflation of 4%, your net real estate return is 12%, okay, versus a net of stocks 4 to 6. So this is both like, yeah, go for it.
So I think one point though, Josh, that you had mentioned too, when we were talking earlier, is you had said the other thing you did is when you were trying to figure out how you wanted to build your wealth, is you just looked at the people in your area and you're like, what do the richest people do, right? And why do they do it? And in your area in Spokane, I'm sure it's probably everywhere, they're real estate guys, right? Is what you found. And is that a big piece? Because it makes sense, right? You want to model, if you have a goal that you want to, one of your goals is to become wealthy, do as well, be as efficient as you can. You want to see what the other people are doing who have more money than you.
That's a great point, Eric. So, you know, you have to figure out like I've learned who I am over the time, and I love real estate. I love creation. I love building things, right? So this is a passion for me. This isn't a job. This is something I love to do. But then too, you got to look at the landscape you're in. In dental, we have challenges, right? We have fixed reimbursement. So every year, our revenue per procedure isn't going up, right? But our costs are, right? So the walls are squeezing in on us in dentistry. I don't want to be in an industry long-term where the walls are squeezing in, right? In real estate, I can raise rents every year, right? So I can raise my revenue. So it's a much better playing field. The other part is like I look at numbers, right? I'm finance, honors finance at University of Washington. Like I love numbers, but I also look anecdotally around me. And the wealthy guys in my area, which is a tier 2 market, it's not Seattle, it's not Portland, tier 2 market, Spokane, like real estate developers, you know, $1 billion net worth, 500 million net worth, 200 million, 200 million, 300, 100. Like when I interview these guys, get to know them, these are their net worth. And this is why, right? The compounding of the returns over time and tax mitigation. Good? Okay, so you can disagree with this, but I want you to understand kind of the lens through which I look at real estate and why I value it as an asset class. The second thing is like, well, how does that look over the long term? So what I did here is I went into I think like investor.gov or whatever, and I put in $200,000 invested for 25 years at a 16% annual average return and at a 9% annual average return. Okay. So you can see just compounding over time, the difference. And so it's not like you need to take all your portfolio and put it in real estate, but if you want to accelerate your wealth building, like real estate is a good idea. Any questions from anybody on this curve about like the fundamentals of real estate.
Hear that hand?
No, but Josh, someone had asked a question, is the plan for the fund to recapitalize in the near future? If so, can it be reinvested in the fund? I don't know if you want to answer that now or later.
Yeah. So, we're going to recapitalize through a refi. That cannot be reinvested in the fund. That is money you will take outside, and then you can redeploy that where you want. I'll have development deals. You'll have your own investment opportunities, so you'll have that cash. The other way to recapitalize is to sell. We don't want to talk about selling. Just in your brain have like, okay, this is a 10-year fixed long-term strategy. We're going to sell after 10 years. If something became really, really profitable, there is a way to sell in the middle and roll that money into other real estate within the fund. But the numbers have to make sense, and there's taxation on that first sale. But your original capital gain keeps on rolling. So let's say in 5 years, we're in like an amazing market. I'll run the numbers, I'll consider it. And if the numbers is a net positive benefit for everybody, right? And it makes sense, then I'll go over that with everybody. But I think the simple version is just lock in your brain 10-year investment. Good? Because that's what QOZ requires for your capital gain benefits, the no capital gain and the no depreciation recapture. Good? Okay. These are great questions. Okay, so I do retail primarily, a little office, and multifamily because I understand them. Okay. I don't dink around with industrial. I got nothing against industrial. I don't have anything against RV parks. Like, those are all good assets, but like, I'm going to do what I do well. Right. So we're going to limit to mostly multifamily, probably some retail, possibly maybe office. Every once in a while, a real stud office deal comes up. But so let's talk about housing shortage. You guys, if we read the news, basically here's the gap. Okay, we are short on housing. Okay, so when people have enough money and the interest rates are low enough, like, people move out of their parents' house and they go find housing, whether it's apartments or homes. Eric, any questions here?
No, that makes sense.
Okay. New supply declining. As interest rates have gone up, it's been harder to develop, right? You can't just buy any piece of land and build on it and make money, right? You got to be smart. You got to buy the right piece of land at the right price, and you got to be like a smart builder. So what happens is less permits come out. So this is what the new supply is. Permits, new permits, new units hitting the market, right? Finished multifamily has been shrinking, so, which is good. Here's the other key piece. So typically, if the cost of buying a place monthly is greater than 30%, is 30% higher than the cost of renting, people are going to rent. Okay. And if the cost is less than 30% more, they're going to buy on average. So if I can pay, let's say my apartment rents are $2,000. Okay. If I can buy a home for $2,600 or less a month, like my payment, I'm probably going to buy a home if that's something I want and have the option to. But if it's greater than $2,600, that's when you see more people stay as renters. Okay. And nationally, the gap is huge right now. This is like the whole unaffordability crisis. And so this is why multifamily is so valued. As long as population continues to grow, right? Like, they need somewhere to live, and it's super expensive to buy versus rent. This is a key slide. Any questions on this one?
Yeah, Josh, is this though very like market dependent? Because I live in Denver, right? And we own a home and it's gone up a ton, right? Like it's gone up a ton,
Yeah.
but I've also heard from people that like, they're like, I can't afford a home, but I also can't afford to rent anything because they're both shoot. So what's Spokane's market like?
100%. It's not even Spokane, it's the sub market. And I run all the comps. I have other properties in development here that are not opportunity zone. It's 40, I think it's like 40, 45%. I have the comps on this. So it's good. It's way above the 30.
Okay.
Yep. Good question. Real estate is hyper local. I'm giving these graphs just to give like base numbers for folks, but 100%. I'm always, it's hyper local. What's the market numbers?
Josh, when you talk about multifamilies, are you talking about, let's say, 50-unit apartment places or 2 or 3 family homes?
Yeah, so I'll talk about, I am being broad right now. Specifically, I typically consider multifamily like 5 units or more. My current developments are smallest is 30, largest is 255 units right now. That's mostly multifamily. We do have a townhome project we just kicked off, which is 84 units, and we're looking at another townhome project as well, which will be probably 25, 30. So.
And do you have your own management company that does the rehabs and does the repairs, et cetera?
Construction, yes. So again, mostly I'm doing ground up, so not a lot of
Okay.
rehab. Yeah.
Okay.
If the numbers on rehab make sense, but anybody who's tried to like bid out TIs on a new dental practice
Right.
knows
Expensive.
rehabs are pretty expensive right now. So I find it better
Okay.
to do
Josh,
that.
are these existing units that are generating income, or are these ground up that are being built, or what stage are you in with all these units?
Ricky, great question. So the are you talking about me or opportunity or this opportunity zone fund?
Well, I'd love to, I mean, I guess the Opportunity Zone Fund.
Okay. So opportunity zone
Or both.
fund.
I'm just curious, both.
So opportunity zone fund is there to stimulate redevelopment. So
Okay.
anything in opportunity zone fund has to be either a dilapidated building or land to start with. So we go in and acquire that dilapidated building or land. And the typical structure is to assemble the fund and then go out and acquire. Okay. It just so happened that a couple of my properties were in opportunity zone funds already. So I already have one that I'll share with you here pretty soon that's pretty far down the road. That'll be our anchor property, and it'll give you an example of the types of properties that we're going to do. So good.
Does section I don't know if it's the right term, is Section 8 housing, does that fall into that category of an opportunity zone?
Different, completely separate programs.
Separate,
Okay.
totally. Okay.
Yep. But they're both based off of something called AMI, which is like average median income. Typically, Section 8 is like 30% AMI, where like the properties I work in are market rate. At least this one. There is one property that I potentially could do for us, but I applied for grants with the city. It'll be 3 million of money from the city to potentially do that one. It still wouldn't be Section 8. It would be just a few of the properties would be like a few of the apartments would be like not Section 8, above that. But it has to be pretty clear for me to include it in the fund. Makes sense. I'm willing to take risk with my own money, but with other people's money, it's got to be like the fundamentals on this one are amazing.
Okay.
Okay.
Thank you.
Yep. Okay. So actually, here's the first project. Good job, Ricky. You had it. You knew ahead of time. Okay. So this is, you guys can look up the address if you want. So this is on the South Hill of Spokane. So this is literally like 6 minutes from my house. So it's got like a cool bar and grill across the street called Wisconsin Burger. It's like this hill that's on top of the neighborhood, kind of looking down on everything. And if you go up there, there's 2 houses right now on there that are rented to folks, and it's kind of like a park environment. So this is we control this property, we own it. It's currently we're going through architectural engineering, kind of fine tuning little things, and we'll submit to the city for permit probably next week. So This is going to be a 92 unit Class A multifamily. We have a tax abatement in place for 12 years, so we won't have taxes on the vertical structure. It'll just be taxes on the land. Our avatar here is so I'm giving you kind of an example of the type of properties we choose, only great fundamentals. So we're about 5 minutes away from, it's called the University District in town. So we have 5 universities right around the river. Gonzaga, University of Washington, Washington State, Whitworth, Eastern, maybe one more. Whitworth, I don't know if I said that one. So you have like the grad school, a lot of grad schools down here. You also have like young professionals, right? Young professionals like to be around bar and grills. They like to be around coffee shops. So this is a nice spot. It's close to downtown, but not in downtown. This is a good spot. Fundamentals, Spokane is a slow and steady market. Okay. This is not a Miami or a Phoenix where you're going to see huge gains and then huge losses. Okay. We're slow and steady over time. What's nice is we have a lower cost of living and we're surrounded by like 60 lakes. So anybody who likes, skiing, water skiing, boating, and in the winter, we have a ton of ski mountains, 4 seasons, no humidity. So this is a very nice place for people to move. Down the road from us is Coeur d'Alene. So like Northern Idaho is very popular. Like a lot of Hollywood people move up there. It's just a nice, quieter life. So we have good income level. South Hill's about 109,000. So that's great for multifamily, and occupancy rate 95%. We're also nearby to a really gentrified, cute little area called South Perry neighborhood. It's got a lot of like, bar, pizza shop, coffee shop. It's a fun little spot. So, some of the value adds here is, recently zoning changes have allowed like higher density maximums. So we try to add value at every level. And then we just try to make them look really good. So here's our site plan for this one. Wisconsin Burgers over here. People kind of drive up. Building A, Building B, clubhouse. All this has views going to the north. And then here is our design aesthetic. I pulled this from a lot of like Montana, Bozeman properties, very that mountainy, simple, clean, but mountainy feel to them. And then because our market is like 25 to 40-year-olds, which is, we also want to have that like coffee shop vibe. So this is our aesthetic design for the interior, so people can like work from the clubhouse. So we'll take this shuffleboard, we'll make this tables instead. So any questions on the summit?
Yeah, one question, Josh. So is this within an opportunity zone?
It has to be. They have to be. This is
so
one.
Can you help explain then how because to me, like I had heard you say like, oh, the income level's high. This is a nice area. It's around here. I guess my disconnect is like, why is that in an opportunity zone then?
So, what the Trump administration did the first time is they went to the governors, right? And they said, hey, you guys designate areas you want to be opportunity zones. Okay. And they had an AMI, I can't remember what it was. It was like 130% or something. Okay. So if the average median income in Spokane's like, let's say 80, right? It could be up to 30% greater than 80,000 a year. Okay. So the governors and whoever they had appointed, they just chose these tracks. So it's not split by neighborhoods, split by like census tracts. So they pick these tracts within these neighborhoods. But what's interesting is like, when they did this in 2017, 19, like the entire downtown of Portland was selected.
Wow.
So it was really up to the governor's discretion, right, and his team about which tracks were chosen. So yeah.
So you can kind of take advantage potentially of certain areas because it seems like it was pretty broad on, because in my head, I hear opportunity zone, and I'm probably like what Ricky was saying. It's like, oh, this is like Section 8. This is like Cabrini Green in Chicago, right? Is the only place you can develop. And I think you're saying there's a lot of potential pockets that are way safer and way better than developing there. and you can still take advantage of it. Like
I'm not interested in that, right? If I'm asset managing these, right, and we got like drug deals going on the property, like I'm not interested in that, right? These are like I said, nurses, young professionals, like that's the demographic I'm comfortable with because that was the demographic I was, so I understand that demographic, right? Yeah, we are not interested in low AMI, 30-50% AMI. We're not doing it.
All right, cool. Thanks.
Good. Okay. I don't need that stress in my life, Eric. And I don't need the sad stories. To be honest, like there's a lot of sad stories that happen at those developments, right? And a kid falls off a railing, like things that'll break your heart. And I'm very hard in certain ways, like built like iron, but when it comes to like kids' health, kids' safety, like I just can't. That's just not something I could tolerate as a human. It would break my heart. So good. Okay, good question. Okay, this this is I'm gonna move the risk side to the end because the risk side is where it could really I could talk for hours. Okay, so about Cochran Capital. So development expertise, you talked about some of the properties here. So this is like what we've been doing and what we're doing. Mostly apartments, some townhomes. This is my team. I've got different teams for different things, but these are some of my core team members. So you need your bankers to fund everything, both on the front end for construction debt and then takeout debt. So takeout debt on these, we'll go over risks a lot. We'll go over this, but the best debt is long-term fixed debt. And the best long-term fixed debt is Freddie Mac, Fannie Mae, and HUD. Okay, so they have the best interest rates and they're the longest terms. So that's the kind of debt you want to use when you refi. But because we have a 10-year, HUD is better if you're holding like longer, like 10 plus years. So we'll probably end up using Freddie Mac, Fannie Mae. Wes is fantastic. He was on this earlier. He refused when I tried to make him a panelist, but he's on here. So Wes has a lot of construction expertise. He's a stud. So Wes and I talk daily. Todd's got 30 years of experience. Redundancy, his son also works there. Elliot's worked with Elliot a lot too. Drew and Pete at the architecture firm, they're fantastic. You saw their designs on that last project. They're great. And they really help manage the project, which takes a lot off me. When I'm managing it, it's a lot of micromanagement. So they're fantastic. So any questions, Eric?
Nope, that makes sense.
Summary of terms. So this is a real institutional fund. I set everything up just by the letter of the law, SEC, all of that. So opportunity zone funds, because you have to hold everything for 10 years, you can't keep the fund open for raising funds for 5 years because the 10-year clock starts when you close the fund. Okay. So what we're going to do here is at most keep the fundraise at 1 year at most, which would be April 17th of next year. I may close it earlier, but at most that'll be the investor redemption, right? This is a 10-year hold, long-term. This is for sophisticated investors. So there's not like a redemption, hey, I need my money back. If you really got into dire straits, let's say like you passed away, but your like wife and kids needed funds, we could look at some sort of option, maybe somebody else buy your shares or something. We could look at solutions there, but in general, long-term investment. Distributions, because the nature of opportunity zone funds is you have to do redevelopment or development, it means you have to do construction, get the assets stabilized, and then start with distributions. So when is that? Depends on the project. Like this first one, you look at your normal timeline. These architects are great that I work with. So let's say maybe 6 months to get permit, maybe 9 months at worst. you start construction, usually 15 to 18 months, you get things stabilized. You know, we said 4.5 months, you refi with Freddie Mac, Fannie Mae, that usually takes a couple months, right? So, you know, around 3-year point, we'll have a refinance, and how much cash back will be directly tied to the interest rates at that time. And you always refinance at that time because you're moving from construction debt to permanent debt, which reduces risk, and it's just required, but you just don't know how much money you're getting back. And then you also cash flow and you take depreciation. So when we finish these projects, you'll get a big chunk of depreciation, which will be fantastic, which you'll never have to pay back because it's an OZ fund. So minimum investment is 50K. That's just my standard. I mean, most on this type of project, the numbers are going to be much larger on most investors. But if somebody's cool and they just kind of want to start, I'm usually flexible. Terms, these are institutional terms. So asset management fee, acquisition fee, and like setup fee, these are all like for work being done. Okay. This is not how like I make money. This is like it pays the bills. This is like you being an associate dentist, right? You're just kind of paying the bills. Where everybody makes money and we're all aligned is we have a 7% pref. It gets that's like your money every year, right? Like you are owed 7% a year. Me as an investor, I'm owed 7% a year. And then at the end, you know, either a refi will get some cash back and our profit performance split might start, or at sale is when you know it'll happen. And that's where this incentivizes me to make this profitable, right? Like investors get this reserve first, and that compounds every year, right? So the first 3 years when we're doing construction, 21% is owed without distributions. We start doing distributions from refi from cash flow. That 21% needs to be eaten up before any profit split. So this is a tried and true structure. These are institutional terms. This aligns investors, which I may be the largest investor, but aligns investors with sponsors, which is me as well. So this is usually a good place for questions. Eric, others, please ask.
Yeah. So Josh, I think you answered it first was you're also invested in this, right? I think some of us maybe have been in other investments where we found out that the person raising the money or that was running it or the syndicator or whatever actually didn't put any of their own money into it. And so that is kind of scary when you find that out, because then it seems like maybe they're just more into raising the money and they don't really have an incentive on if it works. So you said you're probably the largest investor that'll be in this. So that's good. And then question, and you might have answered before on the 7% preferred return. So let's say something happens 4 years down the road and you guys refinance and there's some money that can come to all of us. Let's say I get a $50,000 check, right? And do I have to, that's just $50,000 that then can just come into my bank account. I owe no taxes on it, or do I owe taxes on that 50,000?
Yeah, anything that comes from, this is a good question. Anything that comes from a refinance, okay, is tax-free.
Okay.
Any distributions that come from cash flow of the property, right? Each month, right? We get cash flow each month, probably distribute quarterly. Any of those quarterly distributions are taxed at ordinary income. Okay. Now, because we'll have a massive amount of depreciation on this, you won't be taking those taxes on those distributions for a while, and you'll be able to use those that depreciation against other like passive income as well.
Okay.
So great question. All right. Who else has questions?
Can you explain the acquisition fee? These are fees that go to Cochran Capital, the 1.5, the 0.5. Is that correct?
Yep. These are fees that go to Cochran Capital. Acquisition fee, like it takes a lot of energy and time to go find these deals, right? I look at hundreds, thousands, and then negotiate terms, right? And if the terms aren't good, I bail, right? So it takes a lot of work on the front end. So you always want to pay people for work they're doing, like a dentist or a hygienist, right? But you don't want to pay them like big money until the end, so everybody's aligned.
Right.
Yep.
And then Cochran Capital gets a performance fee of 30% after the 7% preferred return.
Right. So 7% times 10 years is like a 70% like return.
Okay.
And then it's a split, right? At that point. So
Right.
yeah.
And this first QOZ, what are you looking to have for the total investment? 10 million, 15 million? What are you hoping? And would you divulge on how much you're going to be putting into this QOZ?
Yeah, great question. I'm 100% transparent, David, so I will give you numbers as I have them. I think one of the issues here is the GPS structure on our deal. We don't know yet.
Right.
But this is my primary
Correct.
capital gain solution, right? So I'll be putting a ton in there, but I'll also be putting a ton in there from other areas, right? So who's going to be the loan guarantor here? You're looking at him, right? And so let's say we put in, let's say 5 million of equity on a deal, on a development, right? And there's $15 million in debt. Who has the largest downside risk?
You would.
Yeah, the fund could lose 5 million. I could lose whatever I put in on the investment side plus the 15. So I have the longest downside risk. And then also like I have a lot of money like in this one already, right? Like I bought the land, I bought I'm paying all the like engineering, architecture, permitting fees and all that. So I have a ton of money in this OZ.
Right. So Summit is when I'm looking it up, it's sold for $1 million. So you bought that for $1 million and it's 2.2 acres. Is that correct?
On this one, let me pull up.
Yeah. Am I looking at the right address?
In the 819 South Hatch. So let me pull
Yeah.
this one up.
Thank you.
Summit. So Scout. Like I'm a numbers guy, David, but I also have like a bunch of projects
You
going
have too
on.
many
So
properties. Yeah, no, I get that. That's
yeah,
fine.
I always need to answer with accuracy, not something like that.
And
So
that's
this one's
appreciated.
actually 4 parcels, and I may purchase one more small parcel next door. So yes, so this like yes, a little over $1 million. Bought this one in January.
Okay, so that's yours listing and bought with Karen Conway of Cloud9 Realty.
Yep.
Okay, got it.
And then Josh, quick question too. So you alluded to it. We don't know what this GPS deal is going to be like, whether it's going to be you can liquidate 5%, 20%, 50%, right? Or if that's over a period of time. So are you also will there be investors who are maybe outside of this GPS ecosystem, meaning like if the liquidity isn't as strong as we want or want it to be, like, do you have concerns of like, hey, we may not hit that amount we want, or do you just extend the amount of time that you allow funds to come in?
That's a great question. So let me give you a very real answer. So when I look at each of these projects, I look at like, how do I solve what are the problems and how do I solve those problems? Right. And so, myself personally and many of my buddies, we have this capital gain problem, right? And then we have an allocation problem, right? How do we allocate this to maximize this life-changing event in the long term for our families, right? And so the OZ fund does that. Like, so one variable is like, how much do we raise? Okay. Like for me, like at the end of the day, like if we just end up doing this first property, this is a win, right? Like we've got a great property, we've got tax mitigation in place, we got a long-term strategy, like we've won. Okay. As I go through and go through this process, I'll get a feel of kind of where we're at on the capital raise. And then I'll say, okay, we're starting to get more in this fund. Like I need to really dive in and start looking at these other opportunities. right? These other OZ opportunities, and start really diving in on due diligence. So extension, I will not extend beyond the 1 year. Okay. So I'm not going to, like, that's it. The 1 year, that will be the latest. Whether I close it shorter, right? We may end up closing it shorter than that. The other thing is like debt, right? Like the equity investors were investing X, but then the banks are investing Y, right? And so our debt terms also affect this. There's a bunch of different kinds of debt that can go into the capital stack to maximize investor returns. And so depending on the interest rates and the market temperament will really, like, I've got another project right now, Eric, that is similar in size to this one, slightly smaller. We are launching to go out for debt like next week. But our preliminary numbers are like, how much equity on that one? Like 1.5 to 3 million, just depending on what the debt structures come back like.
Okay.
Make sense? So
Yep.
like, how much do we need for this first project? Well, like whatever maximizes returns plus cash reserves for mitigating risk, right? So sometimes they're like, oh, you can like take all this debt on the development, right? And I'm like, oh yeah, like I look at that, and if it maximizes return for investors and we have enough adequate cash reserves, I'm like, great, right? And sometimes it's less debt, more equity. It's finding that sweet spot between maximizing returns. But again, I want to sleep at night. Oh, I want you to sleep at night. So we'll get to the risk side, but having adequate cash reserves is a key part of that. And then Eric, the other piece here is always we're going to maximize things, and long term we're going to win. Okay. The question is sometimes you can really maximize things at the beginning, right? And if things work out great, or you can also have like the expectation that like, hey, if interest rates get a little higher or something, then we're going to have a second like fundraising piece, which will lower returns, right? This is probably too complex, but you're always maximizing at every step along the way. So you're always putting yourself in the best position, lowest risk at that time.
Okay, that makes sense.
That's
Josh, what's the total
pretty...
cost of the summit going to be?
Yeah, let me pull up that one. So this one is going to be up.
While you're pulling that up, Josh, just really fast, so you can multitask, which we're also great at, is are there projected returns net fees? Michael had that question. That can just be a quick yes or no. Okay.
Yes, net of fees. You got it. Yep. One sec here. I literally closed all my 100 windows before this meeting, and I have to log in as a different user for my construction side. Give me a second here.
That's a good question, Eric. Thanks for bringing that up.
Oh, of course.
Yeah, it's basically like, I believe in real estate's the best, and I love real estate. Yeah, let's just make some money for our families and build some wealth. Sorry, Eric.
No worries. If you're
keep asking questions, it's just asking.
No, I mean, or if you want to just pull it up and then like share it later or something like that too, we can do that too.
No, I mean, off the top of my head, David, this one's probably around 22 million on this one. I have the pro forma. I have it. I'm constantly tweaking it based off of numbers we have on our other projects and everything, but it's around 22.
So Josh, if it's 22 million and your QZ is 15 million, the 15 million is the equity, and then the balance will be the bank loans. Is that correct?
Correct. And cash reserves.
Okay.
Yep.
Got it.
Yep.
And building upon that one, based on, we don't know who the blue chip investor is yet for GPS. what if this blue chip investor, by keeping our money in the hold co company, would actually create a better return of, let's say, 20 to 25%? And I know you love real estate, but might there be a point where we may be better off not cashing out and keeping it in the holdco company for the next recap if this blue chip company is as good as Hunter talks about?
Yeah, so great question. So I do think this blue chip company is as good as Hunter talked about. But they're not going to be operational. Hunter was very clear on the last
Right.
call. They're not
Correct.
operational, right? So it's really coming down to, yeah, you want me to break down the GPS investment on Holdco for, I'll just give you my 1 minute. So
Yeah.
historically, GPS has done very well over the last 3.5 years, right? Those investors that were in the first deal, 3.5 to 4x return. You're not going to find a better, I haven't seen a better return the last 4 years, right? Like that's a
Right.
fantastic return. Okay. So the question is always, okay, the first question is, what's it going to look like in the future, right? Well, how much different is our business model going to be? We don't fully know yet. We know it's going to be similar. Are the leadership, the key principles still going to be there, right? One thing that made me feel good was, if we're going to triple our EBITDA, okay, there's going to be some same store four-wall growth, right, of the existing practices, but 2/3 of that EBITDA is going to come from acquisitions, and we know
Correct.
Hunter is good at that, right? So on the 2/3, I feel pretty good about, like, Hunter's just going to keep doing Hunter, right? And so I feel good about that piece. The macro piece, like, we don't know on the macro side what's going to go on macroeconomically. And we don't know on the same store growth four-wall EBITDA, right? Those are like the questions, right? So the
very
biggest,
unknown.
very unknown. So the biggest takeaway is typically take some chips off the table, right? Reinvest some of those chips and take what the government gives you, right? If you believe in real estate investing, right? And you have this OZ available, like, take it, right? Whether your portfolio is 25% stocks, 25% GPS Holdco, solar, that's a personal thing that I'm happy to flush out with people, kind of go over their portfolios. But yeah, that's what I would say is that, yeah, that's a good investment too. Which is, yeah. Good.
And just to recap, the reason why you're doing the OZ fund versus buying the summit and building it and keeping it is because you're getting a windfall from GPS and you don't want to give X amount of thousands, hundreds of thousands of dollars or millions to the federal government. Is that the key reason why you're starting this OZ fund?
Yes, and it's 20% that first deferral, right? I love to punt stuff to the future year so I can figure out a new tax solution for that year. It's 80%. I don't have to pay that dang 40% tax when I sell this thing.
Okay. You mean the summit if you wasn't in the OZ?
I'd have to pay depreciation recapture and I'd have to pay capital gains tax at the time, which is equivalent to about 40%. So to me, this is very aligned with what I already do, but a better solution.
Okay. So final question, why wouldn't all your projects be in OZs? Is that because your money's tied up for 10 years in a way?
Yeah, that's a good question. I think I only say yes to great deals. Okay. And so I have some really good properties that are not in OZs, right? But make sense. So I'm not going to say no to, like, a good deal, but if I find good deals in OZ funds, right, it's like a bonus. I'm like, hey, this is both a great deal and it's in an OZ. Like, we're all in on this, is how I look at it. Yeah.
Okay.
Great question.
And there's no risk mitigation to the investors in the OZ fund. I mean, I know you're doing all the work. I know we're investing, but there's no comebacks to the actual investors of the OC fund if there's a issue.
Like, do you mean like if there's
Yeah.
like a natural disaster or something like that, or something happens and
Well, let's say there's an earthquake or the building goes, they find some disaster around the building, or let's say the contractor that Josh hires seems to be great, but then he takes off with $3 million.
You have insurance
There's
for that, right?
Yeah, there's massive risk mitigation at every level. Let me go to the risk slide. This is kind of my last slide
Okay.
besides the Q&A, and we'll start going over it. And this is just like what I could fit on one slide. Okay. So, when you think, let me go global first. Okay. This is a long-term multifamily property. Okay. So multifamily, when there's 95% occupancy, right, in an area and nationally, right, you know that apartments are going to get filled up, and you know that people need somewhere to live, right? And
Right.
so as long as you have adequate cash reserves to suffer the ups and downs, you're going to have a valuable piece of property in the future. How valuable? We don't know, but you're going to have a valuable piece of property. When you look at the wealthiest people, it's widows in the country, right? Their husbands, historically, women are very smart, and my wife is key to all the success that I've had. She's so smart, so wonderful. But historically, you had husbands going out and building all these real estate things, passing away, and all these widows owning all these things, either with low debt or no debt, right? Okay, so that's like the last 30 years, if you look back. So you know that, like, as long as populations continue to increase, like, multifamily does very well. Okay, just on a fundamental level. The three biggest risks are buying for appreciation, like buying a condo in Miami, saying condos in Miami always go up, so I'm going to make a lot of money if I do that. Okay, so don't buy for appreciation, buy based off of fundamentals. Two, long-term fixed rate debt. Okay, like, don't use variable rate debt to buy this is more existing multifamily, not ground up. Don't buy existing multifamily with variable rate debt, because when you use fixed rate debt, you can't afford it, right? That means the price is too high. Don't use variable debt.
Right.
That's what most guys did the last 3 years. The third one is adequate cash reserves, right? If you know long-term, both historically, multifamily does well. If it's, a good product and a good location, like, it's pretty much a no-brainer. Where people get screwed is on those first two, where they don't have adequate cash reserves. Something happens and all of a sudden, oh no, we don't have the cash, right? Like, so what you do is you build in adequate cash reserves. And if you want to push it a little bit, you just say, hey, we're going to push it a little bit. And if, like, the interest rates jump to like 8% at refi, right? This is how much it's going to cost. And we're going to bring in investors at this much, right? And this is what will happen to returns. Like, you just need to plan for the variabilities.
Hey, real quick, Josh, I have to jump off in 1 minute. But thank you for doing this, and hopefully I helped a little bit there. But if anyone has any other questions too, funnel it through him or me, and I'm happy to. I don't know any of this. Josh is the one that knows it all, but yeah, I'm gonna jump off.
Thanks, Eric.
Yeah, thanks,
Nice
Eric.
meeting you.
Yeah, nice meeting you too.
I'll go over risk for a little while with David. Anyone else wants to hop on, but yeah, here's like my contact info. So you have it for the recorded webinar. So
Thank you, Josh. I'm gonna roll, but I'm gonna definitely be in contact.
It's a pleasure. Thank you.
All right, buddy. Nice talking to you. Have a great Memorial Day weekend.
Thank you. You too. Bye.
All right, take care.
Okay, David. So risk. So interest rate, we talked about occupancy rates. We talked about rent rates. Rent rates are correlated with occupancy rates, right? As long as you have decent occupancy, rents come in line. Concessions, same thing. Rent controls. Washington does now have rent controls. The rent controls are, you can raise rents right now. They just put this in. It's now it's 7% a year plus CPI. So if CPI is 3% plus 10%, this doesn't really affect new construction. First of all, new construction's got a 12-year exemption. Okay. But even more, it's really, it's the where this actually hurts people is, let's say I owned an apartment building that was really old and I wanted to fix it up and raise rents.
Right.
Like that's where the real issue is going to come with that.
Got it.
On the deal, we focus on fundamentals. Adequate cash, we talked about that. And then redundancy on sponsor. We got to make sure at every level we have people in place. And then you surround yourself with a great team. So the risks, there's always risk in everything, but we mitigate risk at every level. We have insurance on everything, right? The banks require it, right? They're the largest shareholder, right? And so they require insurances at every level. Any specific risks you're thinking of that you wanted me to?
So let's go back to what Eli had asked you. What do you have in place? God forbid, this is a terrible thought, but God forbid something happens to you, because it sounds like you're the ringmaster.
Yeah. Okay. So yeah, I'll tell you what I have in place now and what I will get in place. Okay. So on the construction side, I have Wes, right? Like those construction completion, we have redundancy there. Once that gets done, you refi, okay? And then you're asset managing. So I have not done this yet, but I have many colleagues across the country that are successful fund managers or successful asset managers, right? So I'm going to pick one of those, and they are going to be our redundancy plan. Someone I know, like, and trust, right? High integrity, high skill set. Property management, there's lots of different property managers, right? You don't like one, you're asking them to do something, you're not seeing the results you like with one of the ones that I do work with, then we'll hire another one. Yeah, and then sale. I mean, it'll be the same person on the asset management for like a sale. So,
and will you have all these things in place before the fund opens, or will it be a work in progress? And they're tough questions, but I've just met you. You seem extremely intelligent, like you know what you're doing. Some of the stuff you talk about goes over my head, but I'm more of a risk taker, and my son's more conservative, and so that's why I ask these questions.
Yeah, these are great questions. I will get those back end things tied up here in the next couple of months. Like I'm not looking to put that off. I like to close loops so my brain is freed to focus on the construction, right? And if I haven't put the redundancy plans in place, then it's like an open loop that causes me stress. So I like to get that. I wouldn't put this this is riskier than stocks long term. Okay, because stocks is index funds, excuse me, not stocks. Stocks are more risky. Individual stocks are way more risky. 10 stocks are more risky in my mind, but index funds are less risky than this. Okay, but with real estate, these are not, hey, let's ramp value in 3 years and sell this thing, right? This is long-term, sophisticated, patient investors, right? That is the risk profile of this. So I want to be very clear.
Why is it riskier? Why is it riskier though?
Than stocks? Than
index funds or stocks, yeah. You said it's riskier, if I heard you right.
Yeah. So
why?
I mean, I think key person risk, right? There's the less people, right? When you're investing in index funds, you're investing in let's say 500 companies, but they also have 12 board members on each company, right? It's like super diversified. Geography, right? Well, let's say we get hit by a nuke, right? When you're in an index fund, it's diversified. So what I always try to do is find a sweet spot. Like the term is risk adjusted returns, right? We try to say, hey, index funds are great for many reasons, right? And they put you on this curve. Okay.
Right.
Let's not get crazy with real estate. Like this, like let's not get super risky with real estate when you're bringing in other people's money, right? Let's think
Right. Got
long
it.
term and mitigate risk, just long, slow and steady type real estate. Hedge funds don't stay around if they lose people's money, right? So I'm
Correct.
not interested in creating deals with risk because that will, I mean, on an ethical level, I don't want to do that to my people I care about, my friends, my family, right? But also
Right.
on a business side, it just doesn't make sense. You're going to put yourself out of business
Okay.
eventually.
Okay. I guess last question will be, and I really appreciate the time. So I did invest with Cantor Silverstein Opportunity Zone Trust 2.
Okay.
How is yours? Well, you may not know the answer to this, but why would I put money with you now versus investing more with Cantor Silverstein?
Number one is the sponsor, right? So you need to get to know them. If you know them already, how well do you know them? You need to get to know me, right? So
Okay.
number one is sponsor. Number two is asset class and diversity, right? Like I don't know what their projected returns are. I don't know what their risks are. I
Right.
don't know their distributions of cash
Right.
flows. And so it's
And I'm gonna compare them to yours. So that's a great point.
perfect. And this is one mistake I think a lot of people make for the last 5 years. I just want to mention
Yeah.
putting money between 12 different investment opportunities is not reducing risk through diversity.
Right.
It's about fewer, deeper relationships where you really get to
Correct.
know that sponsor, okay, on the same page. And then maybe you're investing in different funds, right? Okay, this one's here or this asset class and this location. So you're diversifying that way.
Mhm.
But yeah, that is one mistake I see is too much diversity of sponsor
Okay.
creates you can't keep track of that
I mean,
many
I
people.
do like the point that it's right in your backyard because you are right. If it's across the US and you're not nearby, you lose all that control.
And I'm most likely going to be the largest equity holder on all of these projects,
Okay.
cash in. So
All right. Beautiful. So I guess we wait until for the next few weeks till we get that letter from
yeah,
GPS to see
so
what percentage we might be entitled to. I do like your
yeah,
point about taking some chips off the table. That makes sense. Not
I
putting
would
all our eggs in one basket.
I would say here's my contact info. If
Okay.
somebody wants to kind of walk through their situation, we generally have an idea. We're probably going to get somewhere between 20 to 35% of cash up front and then
Right.
additional funds over the next 18 to 24 months, right? Up
And are
to
you assuming
50%.
the sidecar is going to be paid? Do you have a sidecar?
I do.
I do too. Do you assume that's going to be paid out in full?
At this point, I've heard nothing contrary on the sidecar
Okay.
piece. But that might be
So the
included in the percentage, right? We don't know when he says
I
it's
got
too
you.
vague. It's too vague.
Got it.
So generally speaking, we all know we're at 20 to 35%. Not know, but
Okay.
suspect. So we can do, if anybody wants to stop on the call, kind of look at their deal, how generally, so they have like an idea of where it's headed. If
Right.
they also want me to
Okay.
look at their overall portfolio, and again, I'm not a financial advisor, accountant, or legal, but just give them an idea of like asset classes and balance. I'm happy to
Okay.
walk through things with folks.
Okay. And Josh,
And
one last question. So I own a 4-floor, 16,000 square foot building, and I got a fantastic lease from GPS over market rent. And I was thinking of selling the building to a REIT to get a higher return. Do you have any opinion on that, or do you think I should keep the building? It throws around $100,000 a year to us in cash flow
okay, I'm going to give
after
you my
expenses. After expenses.
after expenses. Okay, about 100K a year.
Yeah.
How much is it worth?
Well, the local broker says 1.1, 1.2 million. The REIT and the appraisal we recently got said 1.7 million. I would sell it for the 1.7 million. I wouldn't sell it for the 1.1.
Yeah, when you look at the numbers. Yep.
Yeah.
So what I typically do is called a return on investment versus return on equity comparison.
Okay.
When you
Right.
look at your return on investment on this, you probably did quite well. Okay.
Yeah, I did.
Now what I look at is how much equity do you have in that building? Okay. And then I look at your cash flow compared to the equity that you have. So we're return on
Okay.
equity. Okay. And oftentimes yours might be better than that, but oftentimes the return on investment for folks is like 20%, right? It's real estate. Like in
Right.
general, it does well. So I'm like, okay, you got like 20% return on investment, you're doing good, like per year, but your return on equity is like 3% in the equity you have in it
Right.
now. You either
Yeah.
need to refi, take some cash out
Okay.
and deploy it in a
Got it.
higher return. But if you don't want to refi for some reason, like you'd rather not keep it, right? You want to diversify your portfolio, then it's like, okay, yeah, you could sell it, but then that's when you come into the same capital gain rate and depreciation
Yes.
recapture,
Right.
right?
Correct. Yeah.
And so I typically don't sell
Okay.
unless I'm putting it into a QOZ or I'm putting it
Okay.
into a 1031, right?
Got
Otherwise,
it.
the taxes are just so burdensome.
Yeah.
And it's a
You end up
new,
losing money. It doesn't pay to sell it.
yeah, unless you really just want to sell it. Like, they're opening up
Yeah.
like a halfway house next door to your building in like 2
Right.
years,
Yeah, I got you.
right?
Yeah.
And then I'm like, okay, time to put this on the
Right.
market before this becomes public knowledge.
Right. We just
Uh,
formed a trust. So the building is in our trust, my wife and my trust. So it could
yeah.
go, forever with the kids and everything.
Yeah, I'd have to walk through, it'd probably take me about 25 minutes to really ask good questions, right? And then
Okay.
ask you a lot of questions. And then it usually becomes pretty clear. Like I do this a lot with
The
dental
taxes
practice.
kill it. Right.
Yeah. And then, yeah, I
Yeah.
do this. Yeah. So
Okay. And can you email me your contact information and any of the slides you're willing to share with me to my email?
yes, I'll email you the whole thing.
Okay.
What is your email, David?
DRDPECK@me.com.
Let me just repeat back.
Yeah.
DRDPECK@me.com.
Perfect. Thank you.
Yep, my pleasure. Thank you, David.
Okay. I'm very interested, and let's see what GPS tells us in the next few weeks. And we can talk
Yes,
more.
we will
Yeah.
know more now.
All right. Sounds good.
Bob?
Thank you very much.
Yeah, my pleasure,
Take
David.
care. Bye-bye.
But Bob, I just promoted you to panelist if you have questions. Bob should be bopping back in. Dan, Kevin, did you guys have any questions? I'll promote you to panelist. There he is. Good morning, Bob, or afternoon.
Yeah, I didn't click on the promote to panelist quick enough. It went away and I couldn't see how to bring it back.
Oh, no
But
worries.
a great presentation. Appreciate it. Yeah, I'd like to actually get that information via email as well, if that works.
Yeah, for sure. What's your email there, Bob?
It's docbob7, so DOCBOB7 at Gmail.
docbob7@gmail.com.
Yeah, DOCBOB7.
Will do. Any questions for me right now? I can turn off actually recording. So